Hey team, and welcome everyone who is planning for retirement. I'm really excited to share with you what I've been learning lately about how you can supercharge your retirement income using your home equity. Now, traditionally, retirement income planning focuses on three things, right? Social Security, pensions, and then all your retirement savings and 401ks and IRAs and the like. But most people are retiring today with very little money saved up, and employer pensions are almost extinct. It's a really big problem, and it's called the retirement crisis. At the same time, we're finding it's very common for people to retire with the bulk of their net worth tied up in their home. It's in their home equity. That means retirees really cannot afford to ignore their home equity as a source of wealth to help them fund retirement. Of course, the traditional solution to this has been to sell the family home and downsize, move to a smaller place in a less expensive part of town or city or even a less expensive state. This is a really tough decision for retirees, though, because the overwhelming majority of them want to stay in their home. They want to stay put and age in place. Now, fortunately, there is a really powerful financial tool that's designed specifically for seniors to be able to utilize the equity in their home. It's called a home equity conversion mortgage. It works differently than any other mortgage, loan, or line of credit that you've ever seen before because it's specifically designed to serve seniors. So in this video, I'm going to show you how the home equity conversion mortgage, or HECM as it's called in the business, is really a powerful strategic planning tool that can supercharge your retirement income. Then, if you want to learn more after this video, I'm going to put a link down in the description box that'll take you to a free online class. It's about 55 minutes or so that you can take to dive into more details with Don Graves of the Housing Wealth Institute. He put that together, and I've gleaned a lot of my information from him and his course. So thank you, Don, for your education on this topic. All right, huddle up, team. I hope you're all doing really great. And if you're new here, my name's John Thorman, and we are your financial success coach. Our mission, we're here to help you achieve financial freedom faster so you can enjoy it longer. We're going to tackle this topic right after you crush that like button and subscribe to our channel. We want you coming back every week for our training videos because they will help you improve your financial fitness. Now, a home equity conversion mortgage is specifically designed for homeowners age 62 and older, and it's designed to allow them to get access to a portion of their home equity so that they can spend it on whatever they want. And typically, it's done through a lump sum or a line of credit or monthly deposits into your bank account. One of the biggest draws or features of this home equity conversion mortgage is that it doesn't require any monthly mortgage payments. That's right. So you can actually switch off. If you currently have a mortgage, you could refinance and use a HECM and go from having to make monthly mortgage payments to not having to make any monthly mortgage payments. And of course, that saves a whole bunch of cash flow and will let you extend your retirement assets way longer into retirement. The only, a couple of the big requirements here, though, of course, is that you're going to have to set it up because you have to keep paying your property taxes and you have to keep paying your homeowner's insurance to keep the loan in good standing. Now, the HECM line of credit option is what initially grabbed my attention because of its flexibility. But that's not what ultimately got me really excited about this financial tool, okay? But more on that in a moment. The HECM line of credit is similar to the HELOC that you're familiar with, the home equity line of credit, only in the sense that it allows you to take money out from your line of credit and put money back into your line of credit so that you can manage your balance and how much interest charges you're paying over a period of time. And of course, the HECM line of credit is flexible and responsive. I mean, you can request money from your credit limit and you'll receive it in a matter of days. Now, just imagine what your retirement would look like if you didn't have to make any more monthly mortgage payments. It'd be awesome, right? So if this is sounding to you like a reverse mortgage, you are mostly correct. The home equity conversion mortgage is actually a type of reverse mortgage, but this one is different. This is only available from a Federal Housing Administration approved lender, and it's insured by the U.S. federal government. It's important to note that all reverse mortgages are not the same. Initially, I was skeptical about the HECM, mostly because I didn't know anything about it, right? It was just hearsay. It was just rumors and dramatic stories of people losing their house because they had a reverse mortgage. Well, that's just crazy talk, okay? The only way that that's going to happen is if you don't pay your property taxes, right? Or you violate the terms of the loan by not keeping your house in good repair or not having homeowners insurance on it. It's just like any other mortgage. You would lose it in that situation too. So we have to dig down and get into the details and find the truth. So I've been studying this and getting pretty excited about this as an option for a lot of people. This HECM is actually a powerful strategic planning tool for retirement income. And when used correctly, it can dramatically improve your financial success and even expand and grow your retirement assets so that you've got more of a legacy to leave behind. Remember, you don't have to make a monthly payment, no more monthly mortgage payments. You don't give up home ownership or come off the title, and you don't have to repay more than what the home is worth. Okay? These are very critical points. So let's take a look at what those responsibilities are for a borrower, okay? You have to live in the property. You have to maintain the property. You have to pay property taxes and maintain homeowners insurance. That's basically all you got to do. Now, how does repayment work? Because it is a loan, it is a debt obligation. Well, that loan is repaid when the last surviving borrower permanently leaves the home. So typically that's going to be either because you moved out or you have died. At the same time, whatever proceeds were advanced to the borrower, right? So how much you took out of that line of credit, plus the interest, plus the fees, okay, the insurance premiums will have to be repaid. 100% of the remaining equity is yours, and it gets passed on to the borrower or their heirs or the estate. So you own the home, and it's just like any other mortgage. If you want to move, you can sell the house, and whatever equity is there is yours. Or if you die, then whatever equity remains after paying everything back goes to your heirs. Now, comparing this to the home equity line of credit, during the 2008 great financial crisis, and again during the pandemic, a problem with conventional HELOCs, the home equity line of credit, surprised a lot of borrowers, okay? Because their HELOC lenders chose to terminate, freeze, or reduce the amount of credit that they were making available to them. That was a big shock and not good for a lot of people. So this is another point of big distinction and separation between the HELOC and the HECM. With the HECM, the available line of credit is guaranteed, okay, to be accessible when you need it throughout your entire retirement. The whole time that you're living in that house, you're going to have access to that line of credit. They can't cancel it on you. As long as you're adhering to the terms of the agreement, right, then you're going to be fine. And here's another significant difference between a HELOC and the HECM. With a HELOC, you typically have a very short period of time to draw money from. It's normally 5 to 10 years. And then you switch from just paying interest to now you've got to pay like a regular mortgage payment and get that thing paid off. Well, with a HECM, it doesn't work like that. You can always draw from that available balance. Another advantage of the HECM is that typically what's required for you to qualify for that home equity conversion mortgage is much easier than a HELOC. So that's a bonus as well. And I like the fact that the HECM is a non-recourse loan. So that means if the value of your house goes down, let's say there's a stock or a housing market crash, and the value of your house drops by 30%, and you actually owe more money on your HECM than what the value of the house is, the lender, because you're paying that mortgage insurance premium, the lender will not come after you for the difference. They will accept the sale price to pay off your balance. Now, this is really exciting. This is really important. If you only used the HECM line of credit as a volatility shield to protect your retirement assets from losses in the stock market, then this thing would be totally worth it, okay? First, let me show you an example of what happens to your retirement portfolio if you don't have any kind of stock market volatility shield. So here's an example of a couple common strategy. They have $500,000 in their retirement account, and they're going to start by withdrawing $27,500 a year at the beginning of the year, and then every year have that go up a little bit to keep pace with inflation, okay? Well, you can see in this first line, in year one, at age 65, 500,000 retirement assets, their investment portfolio went down. The market was not good to them that year, and they lost 9.3%. The same time that they're pulling money out. So the value of their portfolio at the end of the year went down. Again, second year happened again. The value of the stock market went down, and so the value of their portfolio went down. And even though years 3 and 4 were big gain years, they didn't get back to their original balance. So over the course of time, you can see all the way down here, we get to the end. After 23 years, they're out of money. So this is a retirement crisis, a major disaster, and it's what we call the sequence of returns risk. That's what happens when your market-based portfolio has got a lot of volatility, and it's going to go up and down and up and down. And depending on the timing, if you get hit with a couple of bad years early on, it kind of puts it into a death spiral, and you can't get out of it unless you seriously, change up your pattern of withdrawals. But you got to live on something. So how do you do that? So that's where this volatility shield concept comes in. Look what happens to the same kind of situation. We have a different couple, but the same thing. They had $500,000 in their retirement assets, but they got a home equity conversion mortgage, okay? So the property value starts out at $416,000, of which they were able to get a line of credit to start at $162,000. They suffered the 2 down years in the stock market, just like the other couple. But here's the difference. In years 2 and 3, so the year following a down year in the stock market, instead of pulling more money out of their retirement account, what they did was they used their line of credit for from their home equity and paid themselves that way. So by doing that, you give your retirement assets time to recover in the stock market before you sell more shares. It's brilliant. It's how this thing works. And you can see after those 23 years, if I just compare the same time period, 23 years, this couple's got nearly $1 million in their account versus the previous couple in 23 years, they were out of money. So just by making that one switch and using your home equity conversion mortgage as that volatility shield, so when the market goes down, you don't sell any more shares, you pull money out of the equity in your home, you can extend your retirement, extend your, and actually grow your retirement accounts so that you can keep pace with inflation through 30 years or more of retirement and not have to worry. Now, finally, here's the unique feature of the HECM line of credit that really blew my mind, because I did not know this existed. I didn't know that was possible, but this is a growing line of credit. Unlike the traditional HELOC, you get approved for X amount of dollars on that HELOC, and generally you can, spend only up to that amount, right? With the HECM, it doesn't work like that. With the HECM, you're locking in the equity in your home in today's market, right, which is good, right? Because home values are way up. You can lock that in, but then every single year after, the amount of money that you can borrow is going up. It's actually compounding to your advantage every year, so you can borrow more money. So let's take a quick look at this example. Let's say your initial line of credit that you're approved for is $200,000. That's only for year 1. Year 2, it's going to go up, and every year after that. So by year 5, in this example, if the interest rates are at 6.75% and you make no withdrawals ever, in year 5, you could borrow up to $287,070. Again, if you just keep it open and you don't borrow any money out of this, take no withdrawals, in year 10, you could borrow up to $412,056. But what about, look at this, in 20 years? So if you retire at 65, at age 85, you could now borrow up to $848,911 against your home equity. This balance, this goes up every year, and it doesn't matter what's happening in the economy or the actual market value of your home. You're getting this compounding growth on how much you can borrow from your home. It's super powerful. So, are HECMs worth the cost? Because generally speaking, a HECM is going to be more expensive than a HELOC. But they also have these tremendous extra benefits that are specifically designed to support retirees, right? So we got to take a look at it. And, I love the quote by that brilliant economist, Thomas Sowell. He says, there are no solutions, there are only trade-offs. So you've got to decide if the trade-offs are worth it for you. Do you want to have a growing line of credit through your 30 years that you're going to be retired? It sounds good, right? Do you want to have a volatility shield that you can use to protect your retirement assets and not have to sell when prices are low? Yep, that's pretty awesome. Those are some really good trade-offs, right? So it may well be worth it for you to get this set up. And what the studies, the research into this has shown that the best results are when you open up the home equity conversion mortgage right away, early, like at age 62 when you're first allowed. If you're going to plan on staying in your home and age in place, get that HECM as soon as possible and let that compounding benefits come to work for you, and then use it as that volatility shield and use it as to spend later in your retirement age. That works the best. So what can you expect to pay for the HECM? What are the costs? Well, there's upfront costs, and then there's some annual renewing costs. Upfront, you're going to have a counseling fees like $150 or so, just to make sure you understand how this debt obligation is going to work. Okay. And then there's a property appraisal. They need a current appraisal to see what the market value of your home is, so you can lock that in, and that'll be about $500. Like any other mortgage, there's going to be an origination fee, and the maximum allowable fee, though, with this program is $6,000. So somewhere between $2,500 and $6,000 will be your loan origination fee. And then there's the mortgage insurance premium. And if you've purchased a home and didn't have 20% down payment, you probably had PMI, private mortgage insurance. This is similar. This is the insured part to make sure you get all the benefits of this program. Oh, and then the ongoing costs, of course, there's an annual mortgage insurance premium and the interest, of course. But if you don't use it, if you don't take any withdrawals from it, then that would be zero, right? So just quick example, let's say you open up the HECM right now and you don't withdraw any money. You got $12,000 in closing costs that you're going to roll into the line of credit, right? And it's 6% interest, and 0.5% is the annual ongoing fee for the mortgage insurance protection. That cost would be $780. So at the start of the next year, you'd have $12,780 balance if you didn't make any payments on it. Here's a quick recap of the benefits and the differences between the line of credit and the HECM line of credit. So do you own the home and remain on the title? Yes to both. As an adult, is there a minimum age that I need to be? Not with a home equity line of credit. Yes with the HECM, because that's specifically for retirees. You got to be at least 62. Do the unused funds in the line of credit accrue interest? No for both. Are there required monthly principal and or interest mortgage payments? Yes on a home equity line of credit. No on the HECM. Does the unused portion of the line of credit grow over time to produce greater borrowing capacity? No, with the home equity line of credit, right? But yes, that's a major feature, major advantage of the HECM. Is it a non-recourse loan, meaning you'll never owe more than what the home is worth when it's sold? That's a big no on the home equity line of credit, and a big yes, a big advantage of the HECM. Are the draw periods limited? With a home equity line of credit, yes. Remember, typically it's 5 to 10 years for the draw period, and then you got to start paying it all back. HECM, big advantage, no period at all. It's always available. Are there any prepayment penalties? Depends on the home equity line of credit. It's a no on the home equity conversion mortgage. Which product's generally easier for people age 62 to qualify for? Definitely the advantage goes to the HECM there. And can the line of credit be frozen, reduced, or canceled based on market conditions? Remember, that was a big problem with the traditional HELOC. That's a yes, and a big no, which is the advantage for the HECM. So for retirees, the HECM offers some really powerful tools and features to protect and grow your assets, give you greater flexibility, greater peace of mind, and be able to reduce your monthly outflow if you eliminate a home mortgage payment. I mean, just so many good things here. So I don't think you can ignore your home equity when you're doing your retirement income planning. You got to look at that and see what's going to be the best solution for you, right? So do a little bit of research. Like I said, I'm going to put that link down below. You can watch this free presentation from Don and learn a whole bunch more. But then you can request a quote, and you can see what those costs are going to be and what this thing's going to look like for you. All right. I hope you got a lot from this. I'm excited. I think it's going to be a powerful option for a lot of people. And if you know anybody that could benefit from this information, please share this video with them too. Okay. But that's all for now. We'll see you on the next video.